Well, we've been concerned about emerging markets. We saw tail risks coming into the year, and we've been underweight emerging markets in the tactical asset allocation portfolios that we manage at Washington Crossing, mostly having to do with what we would call tail risks. So if you look at emerging markets, they've been in a game of catch-up. A lot of it has been driven by what we would call investment-led growth, and a lot of that investment has been financed by a lot of credit creation, so a lot of debt, in other words. So what we've seen has been a buildup of debt fairly rapidly in emerging markets, and on the other side of that, you tend to have these spikes in volatility, and it manifests itself often in the currencies, which compounds the problem, and that's what we're seeing here.
The theme we continue to hear here stateside, as you well know, is that, listen, things are good here. Yes, the rest of the world has some turmoil, as it tends to, by the way, but that will insulate the U.S., particularly the smaller and mid-cap stocks. Is there any scenario, Kevin, at which what's happening, say, in India with the dollar or Indonesia does start to impact our smaller and mid-cap indices here?
Well, yeah, if you have a slowdown in growth here in the United States, that would be a problem. So, for example, you could imagine a situation where the world's equity markets recouple at some point. It's very strange to have huge parts of the world moving in different directions. So if you did have that and you saw downward pressure on equities here in the United States, maybe creep back into confidence, dampening confidence and wealth a little bit, you could see some spillover effects here in the United States, which would dampen growth somewhat, and that could hurt companies that are where there are high expectations for growth. Right
now, do you remain bullish on U.S. stocks?
Yeah, we like the U.S. over the rest of the world, and we like developed over emerging. That's been our call for a while here, and we haven't seen any signs of change in that direction. Again, it has more to do with risk than valuation. I think we concede that equity valuations have gotten cheap after a long period of underperformance, but we haven't reached that turning point yet. So we're still sticking with the U.S. call. We like developed markets over emerging.